welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we are joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I'm sitting down with two of my favorite financial minds, SVP Chief Treasury Officer Tim Sustak and SVP Chief Investment Officer Scott Wood. Scott, this is your first time, I think, being on the podcast. So would you mind sharing a little bit about yourself with our audience today?
Sure. Yes. I'm happy to be here today. I guess I'll share a little bit about myself. I've been with corporate for 20 years now, originally with First Carolina Corporate. And of course, we've emerged now. I guess it's been over 6 years as Vizo Financial. So I've been in the investments group the whole time, predominantly working with members, helping them with their investing and liquidity needs, obviously paying close attention to what the Fed's saying, what the Fed's doing, which is kind of what we'll talk about today. And just a little bit about myself. Recently became an empty nester. So our daughter graduated last year. So empty nesters. So I had to find a new hobby, and I'm happy to report I found a really exciting new hobby, something that I've heard a lot about over the last year or so. And my children are home for the summer, and they pulled me down and got me started with this hobby, which is pickleball. It's absolutely addictive. If you haven't played it, yep. Anybody of any age can play. When I go to the courts, there's a set of 13 courts near my house. I see anywhere from teenagers down there playing all the way up to 70, 80-year-old retirees. And let me tell you, some of those retirees are very good, especially at the net. Yeah. But it's been a lot of fun. That's my new favorite hobby. So I'm not a golfer, but I think I'm a pickleballer now. I'm addicted.
Okay, wonderful. Well, yeah, my family also plays a lot of pickleball. We have an annual Labor Day pickleball tournament, and it's a team event, and so pickleball is pretty famous in our area as well. But we got to try and convince you. You're down there in the Carolinas. You got to try golf. Come on. We got to get you.
I used to golf, Jamie, but I was so bad I had to give it up. It was too embarrassing. I wasn't improving. So pickleball, I think, is my game for now. I could try. Maybe Fred could give me some pointers on golfing. He's got the skills I don't have.
All right, so let's dive right in. Tim, I'm going to start with you. When we talked last, both you and Fred, forecasted that the Fed would raise rates in May by 25 basis points, which they did. At that time, you also said that you both thought the Fed would hold rates at the June meeting. Do you still hold that opinion?
Well, it's interesting. It's been a little bit of a roller coaster ride since the last meeting. I mean, I think, since the meeting for a number of weeks, the pause was certainly the sentiment. And then, we got that PCE inflation reading that came out a little bit hot, and all of a sudden the market started pricing in 25 basis point increase in June. And, that continued for a little while. Then you had, Fed Governor Jefferson come out, who's vice chair nominee, Philadelphia Fed President Harker came out and both said, hey, we still think it makes sense for a pause at the next meeting, but that doesn't necessarily mean we're done with the interest rate hike cycle. So, that got the markets thinking. And now I think the sentiment is, well, and everybody has their opinion, obviously, right? But I think the sentiment has kind of switched to, maybe now a June pause, but maybe a July 25 basis point increase. Because I think it was Fed's President Harker that said, hey, we could go maybe one on, one off, one on, one off. So, I think that's kind of the sentiment for now. I still think they're going to pause in June, absent, nothing crazy. We still have a week to go here and, for information. But I think absent nothing crazy, I do think they'll take a pause at the June meeting, see what happens, kind of reassess. And, Fed's been pretty transparent. I think we believe them. I think, and Chair Powell said it at the last meeting, right? Look, nobody knows which way we're going to go until we see data. And they've been preaching this data dependency for years, particularly during this rate hike cycle. But now that we're kind of in the nitty gritty, 25s trying to tweak things, the data becomes much more important now than it's been. When we were at the beginning of the hike cycle, they were going up. And not that the data wasn't important, but you pretty much knew what way they were going, and they knew which way they were going. Now it's kind of wait and watch and tweak here and there. So I think they will pause. I think they'll wait to see some more data. But then I think in July, hey, if they feel like they need to go one more, they're gonna go one more. So those are my thoughts.
All right. Well, thank you, Tim. So, Scott, I always like a good debate. So what do you think? Do you think Tim's forecast is good? Do you agree with it?
Well, unfortunately, I can't really debate what Tim said. I agree with him on this point. I think the Fed is ready to pause at this meeting. And the last meeting, Chair Powell kind of set the stage for pausing at this meeting. He kind of said that was something that was in their wheelhouse that they had discussed. And it looks like the markets fully were on board with that. They've been looking for a pause and a rate cuts for months now. So the markets are on board. We had a really mixed data coming in, I guess, and it gives the opportunity for the Fed to sit there and take a pause at this meeting. Tim mentioned, we have a week to go, and we have a week. The Fed's in their quiet period, so we're not going to get any commentary from the Fed over the next week before they meet. So really, the areas where we can get our information is economic data that comes out, and we do have two very important pieces coming out next week. The day before, well, they actually start their meeting on Tuesday, and they'll end it on Wednesday. So on the Tuesday, we have the CPI report coming out, Consumer Price Index, which is a consumer, gives us a measure of consumer inflation. So that'll happen while they're meeting. And then the following day, again in the morning, before they make their announcement by a few hours, we're going to get producer price index numbers. So we'll have those two measures of inflation coming out. So those will be important. Those we don't expect anything crazy there, but say for some reason we saw a little spike, then maybe the Fed changes, maybe they change their mind and have a little bit more of a discussion about potentially raising rates, but more than likely not. And the other area where I would say that you could gather some information is the Wall Street Journal. Typically during these quiet periods, if the Fed wants to get any information out, they typically do that through the Wall Street Journal. That's kind of their official mouthpiece when they're quiet. So I would certainly look at the Wall Street Journal and see if there's in the economic section, if there's an article a couple of days before the meeting. That'll kind of tip the Fed's hand. But I think Tim's 100% right. Very likely the Fed's going to pause at this meeting. I think even the markets they're giving about a 25% chance right now that the Fed might hike. So, 1 out of 4, more than likely they're not going to increase at this meeting. And then going forward, that's the big question mark. Tim mentioned the whole data dependency that the Fed's been talking about. So more than likely they're going to be data dependent and see what happens going forward with, some of the key indicators that they look at. Obviously, inflation being a big one, which will kind of determine whether they raise at the July meeting or not. So there is a kind of a debate now. Will they raise in July, like pausing at this next meeting next week? And then 6 weeks later, do they consider a rate increase or do they continue to pause? I would say for the market that's been looking for rate cuts, that's probably not likely anytime soon. And I would argue probably not even I would not expect any rate cuts this year, barring something absolutely crazy happening in the economy. So, a pause this month and a potential for an increase next.
All right. Well, let's talk about jobs and a little bit of the recession. So May jobs reported of, I think it was 339,000 jobs, which stunned many, as well as, it was over its estimate of 150,000. It caused a little bit of a rally, which may have eased some worries about the recession, but unemployment jumped too. In past episodes, we've discussed that the Fed is okay with the recession. Are we still looking at a recession? And if so, how can credit unions prepare?
Yeah, so that's the recession question is a tough question. I think, so you mentioned the jobs report from last Friday, and the number of jobs created was much higher than what the markets were expecting. In addition to that, the prior 2 months were revised higher too by an additional 90-some thousand, I think 93 or 94,000 jobs were added for the prior 2 months too. So much stronger on the number of jobs added. The unemployment rate did increase from 3.4 to 3.7%. I think the markets were looking for 3.5%. So they were looking for a small uptick there, but they got a little bit higher increase. Wages are still increasing. So it was a bit of a mixed report. Definitely not one that would prevent the Fed from moving if they wanted to increase rates this month or this meeting next week, which we don't think they will. One that won't lead them one way or the other because there was enough mixed data in there that they could interpret it and go with whatever direction they were already heading in. As far as a recession, this is the way I look at it personally. We had a pandemic that for 2 to 3 years that we lived through, right? Mm-hmm. So the economy was shut down almost completely for a number of months. So it created major distortions in the markets and everything we buy, everything we do. Major distortions in employment, retail sales, everything you look at, just it completely shut down. So then we slowly started to get the economy back, right? We started going back to work. We found ways to work from home and things like that. Mm-hmm. People started spending money. We had all the stimulus money. But we had these supply chain issues. So a lot of things that we needed or wanted, we couldn't get a hold of. And we still have that issue with a lot of things that we're dealing with. You know, cars is a big one that they're slowly catching up to demand, but we're still not quite there with all dealers. We're starting to see not to pre-pandemic levels, but cars is just part of it. You know, here in North Carolina and Greensboro, we have a big housing shortage. There's not enough houses out there for the demand. So it's kind of pushed housing prices up in a lot of areas across the country. So we have a lot of distortions. We have the Fed saying that they're comfortable bringing the unemployment rate up to 4.5%, which certainly would be indicative of a potential recession. So the Fed's comfortable with the recession because of this inflation issue that we haven't had to deal with really since the late 80s, or excuse me, the early 80s, right? Late 70s, early 80s. This is the issue that they're fighting with. So they haven't had to deal with that. My personal view is we have a recession coming, but I don't know that it's going to be this year. It could be pushed into next year. Some people are talking about the Fed will be able to engineer a soft landing. Entirely possible. It could happen. It doesn't happen often. And that's why I brought up those things earlier about the pandemic and all the distortions that created. You add that on top of all the normal things that the Fed is dealing with. And I think the chances of not hitting a recession are almost impossible, but nothing's impossible, right? It's possible, but I don't even think the Fed expects not to have a recession. But probably next year is where I would bet.
Okay. All right. Thank you. Tim, late last week, the House and the Senate both approved the legislation to avoid financial default. What are your thoughts on the legislation and how will it impact the financial positioning of this country?
Well, yes. First, thankfully, that is over. All right. I think nobody relishes that time when, government is batting the tennis ball back and forth over the debt ceiling. So I guess a number of things. I mean, first and foremost, we punt the ball down the field till January of 2025, when we get to do this all over again. So, hopefully we come up with some more permanent solution to this. And I guess, a number of them have been suggested, but hopefully we can, get out of this cycle, because I'm not sure that it does anybody a ton of good. But that being said, so, a couple things, to kind of to piggyback on Scott's recession talk, this deal does, it keeps non-defense discretionary spending flat in fiscal 24, 1% cap in fiscal 25. Still, that spending is still a relatively small part of overall government spending. But, when you take some government spending off the table, it won't be a significant impact, but probably will help slow the economy just a little bit on top of all those other things that are out there and, things that Scott mentioned. So that's one thing. Another kind of on the consumer side, which will be a little more near and dear to the heart, maybe to credit unions, is the student loan. So the pause in payments that was put out there during COVID. This takes that off the table, so that cannot be extended. So we'll see payments start back up here, likely in September of this year. However, the Biden administration student loan forgiveness plan, it doesn't touch that. So that's still out there, which offers a number of things to help student loan borrowers. So we'll see where that goes. Don't know where that's quite going to go yet. That's still on the table. But I think the biggest thing that this does is obviously, prevents the default and takes away the stress of, rating agency downgrades and things like that, right? I mean, the United States is still the safe haven for the investor, right? This is the when you hear the flight to quality, right? Everybody comes to the U.S. because of our economy and we pay our debts, and anything that tarnishes that image, that reputation, is certainly not a good thing. And there are others out there in the world like China that would love to step into that role. So I think just the fact that again we come through. We raise the ceiling, we don't default is huge. Last time we went through this and pushed it to the line, we saw S&P actually cut the government's debt rating to AA plus from AAA. This time, Fitch had come out and said, "Hey, we're putting the U.S. on watch downgrade." So never a good thing. It just causes concern and doubt, and that's the last thing you want around the United States economy. So, thankfully, crisis averted for now, because it's obviously to default on our debt would cause wide-ranging catastrophe that I'm not sure anybody can really quantify the effect on jobs, GDP, and credit union land. We certainly have enough asset stress with the rapid rise up in rates that the Fed gave us, let alone starting to play with credit ratings on U.S. debt. So, overall, it's a good thing. Everybody gave some to try and get this done, and at the end, everybody knew that it had to get done. So probably not huge effects, but thankfully it's over. That's where we'll end that.
All right. So, Scott, let's talk about liquidity, because I still keep hearing it. So it's still kind of a hot topic. Are you still seeing liquidity concerns among credit unions, going into these summer months here?
We still continue to get a lot of questions from credit unions about liquidity options, what they can do to prepare, basically. So we talked a little bit ago about the recession and what they could do for that. It's hard to know, what exactly is going to happen. But one of the things we've started to see is tightening credit across the industry. And that's one of those things that the Fed is looking at. They're taking into their calculations is how are banks and credit unions, as they're lending, is it tightening up? And we're starting to see that. I saw an article today that's, credit unions captured a lot of the auto market share last year. Mm-hmm. They jumped over banks and the dealership lending and things like that. They actually jumped over. Now they've given back that top spot. So some of these captive markets are doing better. And that's probably an indication of credit unions tightening their credit a little bit, raising rates and things like that. So we're starting to see credit unions take some precautions, whether it's for the recession or whether it's because of liquidity drying up. But we've had a lot of concerns about liquidity. So we've had a lot of credit unions look at the different options, whether it's issuing CDs through the Simply CD program. They could sell loans through the partnership we have with Loan Street. We have a lot of folks that have inquired about the bank term lending program. Tim, I know, has been helping out a lot on that. So we've had a lot of questions about that. We've had a few credit unions that have actually taken advances over that, taken some lines out there, and kind of like we have done when liquidity starts to get tight, and we expect to get tighter, we start to warehouse this liquidity in preparation for these things. So, traditionally March is usually the heavy time of year. That's usually our heaviest liquidity months because we have tax receipts and bonuses paid out by companies and things. And so we tend to see that's the best month of the year as far as cash on hand goes. And then it dwindles as we come up to summer and get into summer as people are taking vacations and spending money. Obviously, we're seeing, this is the one thing we keep hearing about this current economy we're in, is it's really the service side of things, right? So the things like travel, going out to eat and things like that are really where people are spending money right now, and they continue to do so. If you've been to an airport recently, I could tell you the Charlotte airport in North Carolina, I've flown out of there a couple times in the last month and a half. The busiest I have ever seen it. My wife flew out of there a couple weeks ago. She experienced the same thing. It's just been very busy, and it's, and I get these messages on my app. How much are you willing to be diverted from this flight for, basically? And they give you 4 options, at least American Airlines does. Pick the number that would make you happy. Now, I haven't got booted yet, but they're throwing those things out there, things that I hadn't seen before in the last few years anyway. So travel's been really heavy. Mm-hmm. So people have been spending a lot of money there, which would indicate to me that things are going to continue to get tighter for credit unions. We anticipate that as a corporate. We're seeing it with our balances, which are, basically a combination of all the credit unions' balances. Some of the credit unions I've been talking to, the smaller credit unions even that traditionally have pretty low loan to share ratios, they're seeing tighter liquidity too, and they're starting to take precautions, so to speak, to slow that down. So the Simply CD program has been used quite a bit by our members here recently, and then the bank term funding program is another area that's been used a good bit. But we have, as far as selling securities, which historically credit unions look at and they put it in as part of their plan. The losses on those are so great because of this 500 basis points of interest rate increases we've seen the Fed do over the last really just a little more than a year. Let's call it 14 months, maybe 15 months. They've increased that much. So it's really made it a challenge to sell your securities. So you have to look at some alternative mean if you want to make it cost effective. And so Simply CD is a great option for that. But really one that we really like is the Bank Term Funding Program. The rates are super low. You can borrow up to a year. You can pay it off at any time with no penalties. And what that means is if you borrow today at one rate and the rate goes down a week or two from now, you can pay that loan off and basically take the loan out again at that rate, at that new lower rate. So you can save money that way. It's really the lowest form of borrowing that's available right now. And it's even a more attractive option than probably issuing CDs, whether it's to your internal members or through the Simply CD program. So if you do have issues with liquidity, which we have had a lot of credit unions that have been experiencing tighter liquidity, please give us a call. Your corporate account manager, anybody in investments or in the lending team with Tim's group, and we're happy to help you with, show you the numbers for the different options. Here's what the rate is. Here's what your all-in cost would be. This is why you would consider this one versus maybe the other one or versus selling or something like that.
All right. Well, thank you, Scott. Thank you, Tim. Tim, any final thoughts for our listeners today?
Well, I guess a couple things. I guess first would be if you want to know what the Fed's going to do, listen to the Fed. I think they've been fairly transparent, and I think that's the best source for information. I mean, everybody has their favorite economists they're listening to and things like that, which is great. But I think the Fed's been trying to be as transparent as they can be, and I think they've done that for the most part. So take the information from the horse's mouth, so to speak. And I think the other is, to Scott's point, for most of these options for liquidity, it doesn't cost much, if anything, other than some time doing some paperwork to get these things implemented and having, those various arrows in your quiver. And it can't hurt to have them available, in case. And if you never need it, it's like home insurance or auto insurance. If you never need it, great. But you have it, right? And that's the important thing with these liquidity tools too. If you never need them, great. But unlike insurance, you generally don't have to pay for them until you use them. And having them is peace of mind and is, smart. To get those in place before you actually need them. And I know, correct me if I'm wrong, I believe Scott is going to be doing a webinar in June on liquidity options. Am I correct about that?
Yes.
Yeah. So I would just, encourage everybody to tune into that. I mean, Scott has been helping credit unions manage balance sheets for many years across different liquidity cycles and interest rate cycles. And I know that'll be a wealth of information, and, we can find out all about the different options and what you can put in place. So that's all I have.
All right. Scott, what about you? Any final thoughts for our listeners today?
Yeah, I'm going to piggyback on Tim a little bit. And, just the one thing he mentioned as far as getting these things in place and just having them ready to go. For all the different programs that we have, and including the Bank Term Funding Program, there's no fees, there's no cost to do these things. The Bank Term Funding Program, there's some paperwork to get in place. Simply CD issuance, there's a little bit of paperwork to get in place. So certainly get those things in place ahead of time. You never have to use them. It's not going to cost you anything unless you do, but then you're ready to go. The nice thing is once you have the paperwork filled out and you've gone through that process, you can put them in your liquidity policy, which will make the examiners happy. They'll say, okay, you've got this and this, but I can see you've added the bank term funding option, you've added Simply CD issuance. So unless you have the paperwork filled out, they don't want to see those in your policy. So don't add them to your policy unless you've actually got the paperwork done and things into place. And then what Tim said, I don't think we can stress this enough as far as listening to the Fed. Listen to the Fed. The markets and the Fed have been disconnected this entire cycle since they started raising rates 15 months ago. The markets have thought the Fed has adjusted, they both adjusted higher, but the whole time the markets have been lower than the Fed on their projections. And we normally see the markets leading the Fed when there's a new cycle here, when the Fed's raising rates. The markets are normally ahead of the Fed and saying, hey, you've got further to go. This time around it's been different. The Fed has been leading the markets. The Fed has been 100% honest and correct and transparent about what they're going to do. There's really been no question So we do have a little question about next week's meeting, but they've kind of laid the groundwork for a pause. There's really been no question on what the Fed's going to be doing. They've let all that information out there. Chairman Powell is doing a press conference at every meeting now. It's not every other meeting. This coming meeting, we're going to get an updated dots plot. Pay attention to that dots plot and see if there's any adjustments there on the individual Fed members and the median of where they think rates are going to be going after this meeting. Whether they pause or increase at this meeting, pay attention to the dots plot. And as always, listen to those intermeeting comments. So Chairman Powell will do his press conference next week after they make their announcement and decision, and after that's released, he'll do a press conference. He'll take questions. So he's one person. He's a very powerful person, and he's one that he can move that group to. If he says, "Hey, let's pause," and there's still a handful that don't want to pause this meeting, you can bet he's going to have reason why, and they're probably going to all be on board, or most of them will be. I think we had one dissent last meeting. So they'll be on board, but listen to some of the other ones. Tim said about your favorite economist. I really like Bullard, the St. Louis Fed President Bullard. He seems like he's been ahead of this for a while. Remember when the Fed said things were transitory back in the beginning of this, and they were late to start raising rates? He was one of the first ones that came out and says, "Hey, this is not transitory. We need to get moving." And so I would pay a lot of attention. I really think Bullard has been on top of it during this cycle of what's going on. But listen to them intermeeting, pay attention to the dots plot, and you want to look at the markets, but the Fed is where you want to be right now. Because they understand the issues with inflation, whereas I'm not sure the street gets that right now or is fully appreciating the Fed's position. So, as Tim said, listen to the Fed.
All right. As always, thank you so much for joining me. I really appreciate you taking the time and these insights, for our listeners. And I just want to mention real quick, because Tim mentioned, Scott's webinar, Building a Liquidity Lineup That Works for You. That is June 22nd at 2 p.m. Eastern Time. And you can register via Vizo's website, www.vfccu.org. Inform, educate, entertain. Those are the goals Vizo Financial had in mind when creating our different corporate videos. Credit unions are invited to watch all of our videos to learn something new and maybe even laugh a little. We've got a series starring our Chief Engagement Officer and resident jokester, Rodney May, and the shenanigans he gets into around the corporate. We also have a fun quarterly video about solving workplace issues featuring advice from our Chief Culture Officer, Joe Bertato, and his sidekick, Gene Heath. We also have the FOMC update video hosted by our SVP Chief Treasury Officer, Tim Sustak, where he provides an analysis of the Federal Open Market Committee meetings. And since the FOMC meeting is again next week, we'll have a new FOMC update video ready on June 16th for your viewing pleasure. Visit the corporate video page on Vizo Financial's website at www.vfccu.org to watch all of these videos and more. As always, thanks for listening and make it a great day.